Thank you very much, Stephen. Yes, of course, the big story of the day came as no surprise as Stats SA confirmed what was largely expected, that the economic performance contracted between April and June this year. The 0.7% contraction in real terms during the second quarter was better than what the South African Reserve Bank had predicted in their most recent MPC statement. Anisha Packirisamy is an economist with Momentum Investments. Anisha, thank you very much for joining us. The relative performance of all these sectors relative to pre-pandemic levels. Some sectors, it seems, are better prepared at recovery than others. What do you make of this second quarter GDP data?
Thanks so much for having me. We saw that the print came out relatively in line with expectations. At the margin, it actually surprised to the upside. We expected that the devastating floods that hit KwaZulu-Natal in the second quarter of the year and the increased incidence of load shedding would have damaged sectors such as manufacturing, agriculture and mining, your goods producing sectors of the economy. And as you rightly pointed out, that's the part of the economy that was the hardest hit. However, there were some sectors that actually shouldered the burden reasonably well. So we had the financial services sector as an example, actually plodding along reasonably well and lifting up the economy. Unfortunately, however, the balance of the figures did still see a contraction in growth for the second quarter of the year.
Anisha, what was interesting to me was actually when I went back just a little bit to that impressive first quarter of this year. That was revised downwards. It was revised lower from 1.9% to now 1.7%, given downward revisions in both agriculture and mining. Could we expect to see another downward revision for the second quarter of this year?
It's possible that when the data is revised at a later stage, that we could get perhaps another downward revision to this figure. Often we find that in the quarters that lag, we do get some figures that are actually downwardly or upwardly revised. So as you pointed out, agriculture and the mining sector had downward revisions, but there were one or two sectors that actually experienced an upward revision. But again, with the balance of figures, the downward revisions to agriculture were actually greater, and that saw an overall downgrade to the first quarter's numbers. Now, that downgrade to the agricultural figure was quite significant. If we looked at the data a quarter ago, the agricultural performance would have been in excess of 30% relative to pre-pandemic levels. But because we had the numbers shaved down for the first quarter and we also had some of the flooding damage affecting agriculture for the second quarter, the agricultural sector as a whole has only outperformed pre-pandemic levels now by 12%.
This basically still means that our economic performance is not catching up to our population growth, and this remains elusive, and this continues to be the one thing that many will point to in terms of creating the jobs that we desperately need in this country.
As you rightly point out, the economy for the past decade has managed an average growth rate of 1.1%. Now, why is this important, for the average consumer on the street? This growth rate of 1.1% is not enough to absorb the number of people that are coming into the labor force. The population growth over that same decade grew at 1.5%. So the economy is not growing fast enough to actually absorb new entrants into the labor market. And as a result, the cost of living crisis is becoming worse for South Africans at the margin.
Let's talk about what you think of the third quarter that we are on right now and the remainder of the year in terms of GDP performance and into specifically 2023.
If we look at the first half of the year, we actually had an average growth rate of about 1.4%. We are expecting economic growth to increase at 2% for the year as a whole. So that basically puts the growth rate for the second half of the year at 2.6%. Even with the load shedding that we are experiencing, I still think that the 2.6% is achievable. The very high frequency data on things like manufacturing are showing some signs of recovery in the third quarter already. And as a result, that second half of the year is likely to turn up. relative to that collapsing growth that we saw for the second quarter of this year.
We are expecting the lag effect of the inflation and interest rate to actually come through. What are your expectations in terms of how that is going to play out when it comes to consumer spending as we head into the festive season?
I think that the picture for the consumers starts deteriorating and will continue to deteriorate into next year. There are a number of headwinds that the South African consumer is currently facing. As you mentioned, very high rates of inflation. We're also seeing higher interest rates. So if you have a loan out, your debt servicing burden has now increased. We also know that the employment outlook looks a little bit bleak going into next year. Asset price inflation is likely to come off, given what we're expecting for the equity market as well as the housing market. And so these headwinds that are posed against the consumer suggest that the growth rate in consumer spending is likely to taper off into next year as these headwinds start to mount.
One more important one will be if your take on fixed investments and expectations for the rest of the year, including the export markets, particularly as we see what is going to happen in the U.S., China and Europe. Are we also expecting to actually see a recession? Many people are actually talking about it and saying maybe not.
If we look at the fixed investment figures, there are some points of weakness. So we've seen non-residential building, which is your offices and retail sectors and so forth. That non-residential space is almost half of what it was prior to the pandemic. So building plans haven't really resumed in earnest in that particular sector. Where we have seen a bit of outperformance on the fixed investment side relative to pre-pandemic levels comes through on the machinery side of things, as well as what they call other. And within other, we have things like research and development. I think for the remainder of this year, the fixed investment growth is going to remain relatively muted. More than 80% of businesses in South Africa that are in the manufacturing sector say that they are unwilling to ramp up investment plans because of an uncertain political climate in South Africa. And I think that is going to hinder our progress on the fixed investment side. However, going into the back end of next year, I think that we will start seeing some fruits being born out of the energy plan that the Operation Vulindlela, the presidency's plan on the 5-year structural reform efforts, starting to manifest in higher rates of fixed investment. But then again, that's really only at the back end of next year. On the export side of things, I think that export growth is going to soften into next year, given that global demand is also on the downturn. All over the world, we are seeing higher inflation rates really eating into the disposable incomes of consumers, and that means that there will be less demand for South African imports. We think that the US and Europe are basically teetering on the brink of a recession, and they are part of our export trading partners. Fortunately, we may see a little bit of uplift from China. We're anticipating that the growth rate in China will increase from 3.5% this year to just over 5% for next year. They are our largest trading partner, fortunately, so we may get a bit of a buffer there. But in terms of the remaining export partners for South Africa, we will see a bit of a dent, given that growth prospects in those regions are going to be a bit softer next year.
Anisha Packirisamy, thank you very much for your time. Anisha is with Momentum Investments and talking about what has been quite a difficult period for South Africa in terms of economic growth. If you look at year-on-year growth, South Africa's economy was just limping along at 0.2% for the entire year.